The credit card statement arrives. An innocuous email, a thin white envelope. But for millions, it's not just a bill. It's a monthly reminder of a weight, a burden that grows heavier with each passing day. You see the minimum payment, a seemingly small, manageable number. It's tempting, isn't it? Just pay that and move on. But have you ever truly stopped to investigate what that minimum payment really costs you? What secrets are hidden in the fine print of your credit card agreement? What story is your debt telling about your financial future? This isn't just about numbers on a page. It's about the invisible chains of compound interest and the silent erosion of your financial freedom. Today, we pull back the curtain on one of the most pervasive financial traps of our time, credit card debt. We'll explore the hidden mechanics that keep you indebted and reveal why paying it off immediately isn't just a good idea. It's one of the most powerful financial moves you can ever make. Let us start with a simple question that holds a complex and often painful truth. Why should you pay off your credit card debt immediately? The answer isn't just about getting rid of a monthly bill. It's about escaping a system meticulously designed to profit from your delay. When you carry a balance on your credit card, you're not just borrowing money from a bank. You're entering into a high-stakes game where the odds are stacked against you from the very beginning. The primary opponent in this game is the annual percentage rate, or a PR. Unlike the interest rates on a mortgage or a car loan, which are typically in the single digits, credit card APRs are notoriously high, often soaring into the 20s or even 30s. This isn't an accident. It's the core of the credit card business model. Imagine you have a $5,000 balance on a credit card with a 21% APR. The minimum payment required is often calculated as a small percentage of the balance, say 2%, which would be $100. It seems manageable. But here's the devastating reality of compound interest. In that first month, the interest alone is about $87.50. This means that of your $100 payment, a staggering 87.5% of it is devoured by interest. And only a meager $12.50 goes towards reducing your actual debt. Beyond the immediate and staggering financial cost, carrying credit card debt has a profound and often underestimated impact on your credit score. This 3D number is one of the most critical metrics in your financial life, acting as a gatekeeper to your future aspirations. Lenders, landlords, insurers, and sometimes even employers use this score to judge your financial responsibility. A key component of this score, accounting for roughly 30% of its calculation, is your credit utilization ratio. This is a simple but powerful metric. It's the amount of revolving credit you're currently using divided by the total amount of revolving credit you have available. For example, if you have a single credit card with a $10,000 limit and a $5,000 balance, your credit utilization ratio is 50%. Financial experts and credit scoring models like FICO and VantageScore generally recommend keeping this ratio below 30%. Anything higher signals to lenders that you may be overextended and reliant on borrowed money to manage your expenses, making you a higher risk. When you carry a higher risk on your credit cards, your utilization ratio skyrockets and your credit score plummets. This lower score acts like a red flag to potential lenders. When you apply for a mortgage to buy your dream home, a loan to start a business, or even financing for a new car, that low score can lead to an outright rejection. Or, if you are approved, it will be with significantly less favorable terms. Lenders will charge you a higher interest rate to compensate for the perceived risk, costing you thousands or even tens of thousands of dollars over the life of the loan. A person with a high credit score might get a mortgage at 6%, while someone with a low score, dragged down by credit card debt, might be offered the same loan at 8%. On a $300,000 mortgage, that 2% difference translates to over $130,000 in extra interest payments over 30 years. By paying off your credit card debt immediately, you directly and dramatically lower your credit utilization ratio. As the balances drop to zero, your score begins to rebound, often quite quickly. This single act polishes your financial reputation, opening doors that were previously closed and ensuring that when you do need to borrow money for major life purchases, you can do so from a position of strength, securing the best possible terms and saving yourself a fortune in the long run. It transforms you from a high-risk applicant into a prime borrower, a shift that reverberates positively through every future financial decision you make. Think of Sarah, a graphic designer in her late 20s. Fresh out of college, she used her credit cards to furnish her first apartment, buy a new laptop for freelance work, and cover some unexpected medical bills. Before she knew it, she was juggling a combined debt of $15,000 across 3 different cards, each with an APR over 22%. Every month, she diligently made the minimum payments, believing she was being responsible. But she felt like she was running in place. The balances barely seemed to budge. The stress was a constant, low-grade hum in the back of her mind, affecting her sleep and her creativity. Her dream of buying a small condo felt impossibly distant. A quick check of her credit score revealed a number far lower than she expected, a direct result of her high credit utilization. One evening, after staring at her statements, she decided to investigate. She used an online debt calculator and was horrified to see that her minimum payments meant she'd be in her 50s before she was debt-free. Having paid nearly $30,000 in interest alone, that was her turning point. She committed to a plan. She created a strict budget, cutting back on subscriptions, dining out, and impulse purchases. She took on extra freelance projects, dedicating every extra dollar to her highest interest card first, a strategy known as the debt avalanche. The first few months were tough. It felt like a sacrifice. But then, something amazing happened. The feeling of closing that account, of eliminating one of her monthly payments, was more exhilarating than any purchase she had ever made. This victory fueled her determination. She rolled the payment she had been making on the first card into her payments for the second card. The progress accelerated. Within 2 years of that fateful night, Sarah made her final payment. She was completely debt-free. The weight she didn't even realize she was carrying had lifted. A few months later, she checked her credit score. It had jumped by over 100 points. With her newfound savings and a stellar credit score, she walked into a bank and was pre-approved for a mortgage at a fantastic rate. A year later, she was unlocking the door to her own condo, a dream that her debt had once made seem impossible. Sarah's story isn't unique. It's a testament to the transformative power of taking control. It demonstrates that paying off credit card debt isn't about deprivation. It's about investment in a future where you are the one in control, where your money works. For you, not for a credit card company, and where your dreams are not just possibilities but achievable goals. The path to financial freedom is paved with conscious decisions, not with chance. The allure of the minimum payment is a siren song, luring you into a sea of compounding interest from which it is difficult to escape. By understanding the mechanics of high APRs and the critical importance of your credit score, you arm yourself with the knowledge to fight back. Paying off your credit card debt with urgency is not merely a financial transaction. It's a declaration of independence. It's the moment you decide that your future is worth more than the temporary convenience of carrying a balance. It is about transforming your financial narrative from one of obligation and stress to one of opportunity and empowerment. So, look at that statement again. But this time, see it not as a bill, but as a crossroads. One path leads to decades of paying for your past. The other, steeper at first, leads to a future where you are the master of your own financial destiny. The choice is yours to make.